I think we've given everyone quite a lot of time, and I think we should get started. Assalamu alaikum wa rahmatullahi wa barakat. My name is Salahuddin Nasruddin, and I'm the marketing manager for Sharia Portfolio. As many of you know, in Canada, we've started operation quite a while ago, and in January of this year, we have ramped up our approach to the community and our outreach and our marketing. And webinar is one of the excellent ways that that we're using, like everyone else, during this period of the pandemic. Zoom has been the go-to place for weddings. I attended, believe it or not, a gender reveal on Zoom like 2 or 3 nights ago. So there's a lot happening on Zoom. And alhamdulillah, it's a great tool for Muslims to use also. And we've been very, very active in using Zoom to reach all of our clients and, of course, customers and persons who want to learn more about Sharia Portfolio. Of course, you will hear a lot more from our presenter this evening. I wish that all of you are safe. The pandemic is waning, but certainly it's still relevant, and you can still be susceptible to the virus if you're not taking the precautions as advised. So inshallah, be safe. I know some of your masjids are starting to open up, and we of course look forward to as many masjids to open up so we can get back to the community and we can do what we do best, which is to grow our community and to ensure that we can be a meaningful participants in our communities. These webinars, of course, are a series of webinars that we are having. We are doing almost 2 every month. So be sure to take a look at our Facebook, our website for the schedules of webinars. We are going to have questions and answer as we promised. If you have questions, you can ask your question over the chat, and they will be addressed towards the end by our guest today. Of course, like everything else, we've got to show our disclaimer, and just to ensure that what we say is in the right order. Today's presenter, of course, is Nadeem Main. He is our portfolio manager in Canada. He lives in Toronto, and he's well connected to the community. He's known by the leadership, and he has tremendous years of experience. Nadeem, of course, is a veteran equity investor and investment manager who has built portfolios for a wide range of clients for more than 20 years. His broad experience started in New York to Toronto and through various market cycles have given him a unique perspective that clients appreciate and helps to identify situations that reflect greater future value. Nadeem began his career at Oppenheimer & Company, a mid-tier Wall Street investment firm. After returning back to Canada in 2002, he had roles in private wealth management with firms like HSBC Securities, Canaccord Genuity, and Royal Bank of Canada before joining Sharia Portfolio Canada in 2019. Nadeem graduated from Concordia University with a Bachelor of Commerce in Finance and holds a CFA designation. Of course, Nadeem is a great addition to our team in Canada, and leads our team in Canada to ensure that you get the best value from your advice when he speaks to you. He's probably many of you have spoken to him. Many of you might have received emails from him. Here's an opportunity to hear from him tonight, and of course, ask any question that you may have. So Nadeem, why don't you take it from here?
Thank you. All right. Assalamu alaikum, everyone. One second. Thank you again, Brother Salahuddin, for the kind words. I will just share my screen here to begin my presentation. And I'd like to also thank everybody for, coming on today and taking the time out to, attend the seminar, and hopefully this webinar, and hopefully you'll be able to get something out of it, inshallah. So I will begin with, after kind of about myself, I'll begin with just, for some of the newcomers that haven't heard of Sharia Portfolio, who we are, I'll kind of lead with the mission statement or the raison d'etre, because we're in Canada with a little bit of a bilingual flavor here. So what we basically do is we provide, we offer professionally managed investment solutions that help Muslims achieve their life financial goals while making sure that they adhere to their religious values. And that's really it. It's as simple as that. It's helping Muslims reach their financial objectives while making sure they do it in a halal way. We are licensed by the Ontario Securities Commission as a portfolio manager. That is the governing body that does oversee us. We are also registered in British Columbia, and inshallah, the plan is that we will be going across Canada in other provinces, inshallah. Sharia Portfolio, the parent company, was founded in 2003 in the U.S., and they've been licensed with the SEC there for 17 years. As we speak right now, as the brother mentioned, we did get our official kind of go ahead or green light in January of 2020 this year. And so we have been actively taking on clients from Canada. Of course, we have our client base in the US, and we're also now taking also clients from around the world. So we're super excited about this. The firm is dedicated to Sharia compliancy. This is basically what we do. We're not in the business of offering other non-halal or non-Sharia products. This is what we specialize in. This is what we, this is what we believe in. So that's kind of the firm. We also have partnered up with Fidelity Asset Management as our custodian bank. So when our clients in Canada open accounts, the question often is asked, who am I, giving my money to, or where's my money being held? And so the money is basically held at Fidelity Asset Management. And if you've never heard of Fidelity Asset Management, this is a firm that manages about $2.5 trillion US dollars around the world. And that's a big number. I mean, RBC here in Canada, they manage about 837 billion. So just to kind of give you an idea as far as who Fidelity is, it is one of the largest asset managers in the world, not just Canada. The two types of service offerings that we have are Access and Express. And for this discussion, for this presentation, we'll probably be speaking more about the Access offering for the simple reason that today's webinar is going to be about investment strategy, and it's going to be kind of getting into more detail as far as products and what's involved. And the last thing that I'll say is that we're insured by CIPF, which is the Canadian Investment Protection Fund. And if you don't know what that is, most Canadians have heard of CDIC at the banks. In other words, when you go in and you have that little sticker that says, your account is insured up to 100,000 in the event the bank goes bankrupt. Well, with investment firms, instead of CDIC, it's the CIPF. And that is essentially our assurance, meaning if tomorrow Fidelity were to go bankrupt, your account is insurable up to $1 million. So these are just some of the facts that I just wanted to kind of get out to some of the newcomers and even some of the old comers that have gotten to know us but might not know certain things about us, right? So I'm going to dive into the presentation, and obviously the presentation today is about passive or active investing and which one is right for you. So we'll begin with some of the basics as far as, what is passive investing? And, for basic, in the most simplest forms, I shouldn't say that, but passive investing starts with a buy and hold strategy. It's more of a buy and hold even mentality, where what you're trying to basically do is minimize as much trading possible over an extended period of time. as the term passive defines itself, you're not doing a whole lot. So you're just buying and holding. There's a fundamental belief in passive investing that the markets are efficient, and what that means is that the price of the market, the price of stocks, a lot of that has already been reflected. A lot of the news, a lot of everything has already been reflected in the price. So therefore, you cannot add any value to it, and so you're just better off just kind of going with the flow and just letting the market dictate. And last but not least, like one of the most important things about passive investing, actually one of the more popular things about active investing involves the tracking of a market weighted index. So this is probably the most popular form of passive investing in terms of how do you do it. So in theory, it's a buy and hold strategy. It's a belief that, everything is efficient, but in practical terms, what does that mean? Well, it means that it involves the tracking of a market index. And so, just to kind of exemplify that in going a little bit further into that topic, index investing, where you see the top left-hand corner, an index can be, for equities, for example, everyone's heard of the S&P 500, the TSX 60, the MSCI EFI. These are all kind of benchmarks. So in other words, when you're popping on the news and you're looking at, what did the market do, whatever, and what's a benchmark that measures the stock market, you'll often hear terms like the S&P 500 or the TSX. And so these are simply indexes that track the stock market as a whole. So the S&P, for example, is it's a U.S. equity benchmark. It kind of is the barometer for what's going on in the U.S. stock market. The TSX 60 is composed of about 60 of the largest Canadian companies that are listed on the TSX. And the MSCI, which is basically the EFI, stands for Europe, Asia, and the Far East. That's a benchmark that tracks European, Asian, and Far Eastern stocks. So more of an international index. So these are, when you're looking at money managers who are in the market, these are kind of your vitals, so to speak. They look at these indexes as far as what's going on and try to get a pulse of the market. Now, there are also other asset classes that do have indexes, like fixed income, which is traditionally speaking, we're talking about mostly bonds. Sectors where, for example, out of the 500 some odd stocks in the S&P 500, you have a variety of companies like technology, banks, pharmaceuticals, cyclicals, et cetera, et cetera. And so they also have ETFs that can kind of, take bits and pieces of certain sectors. So for example, you could have an ETF that just is solely composed of, oil and gas stocks, for example, right? And the third asset class that which is important to SHARIA portfolio is commodities, where, for example, if you wanted to invest into a particular commodity, everyone kind of, and the example that I kind of threw up here was the spot price of gold, where if you wanted to get that exposure, where just simply investing into the price of gold without actually buying the physical gold itself, there are actually ETFs out there that will do that. So in other words, you're making this investment into the price of gold, and not a gold stock, which is another way of doing it. Now, so those are kind of indexes, just a kind of backdrop of what an index is. And as far as what are some of the investment solutions, or I should say the vehicles or the tools to do this, there are really two types of solutions. Number one, you have index funds, which are similar to mutual funds, but really what they're doing is they're just as the name implies, it's just an index fund. And more commonly, as of late, we've heard the term ETFs, exchange traded funds. Excuse me. And these are essentially funds that will, again, have been formulated to track a particular index. So the example that I gave here is, there's a ticker, it's called SPY, which essentially is an ETF that tracks the spot price, tracks the price of the S&P 500. So on any given day, month, or year, for example, if the S&P is up, say, X percent, say, for the year, let's just say if the S&P 500 was up, say, 10%, then, this ETF is simply trying to track that performance. And the SPY, based on historical numbers, does a pretty good job. It really kind of will, be right around that 10% mark. So similarly, you have other ETFs that are in other areas. XLE is for energy, GLD is for gold. So, again, these are the vehicles and the tools that are used to as a part of index investing. And obviously, with some of the growth that's happened in passive investing, it has created a need or a demand for Islamic indexes. And I think what ends up happening is the indexes are created, and then subsequently, it allows people like us to maybe create product behind this benchmark, right? So we have seen, for example, some Islamic indexes out there. There's the S&P SHARIA Industry Exclusion Index. That is basically an index that goes into the S&P 500 and is essentially applying an Islamic screen onto it. And now you're getting a pool of S&P 500 stocks that have been filtered and been, in my word, halalified, so to speak. And then at the same time, you have other indexes, for example, like the Dow Jones Sukuk Total Return Index. This is a fixed income. This is a fixed income index, and it's centered around Sukuk, which are essentially Islamic bonds. I'm not going to get into that right now because that's a whole different webinar, possibly. But again, that's just to give you a sense of what has been the development when it comes to the markets and some of the Islamic indexes out there. So just looking at some of the pros and cons of passive investing, one of the benefits and really kind of the rise of ETFs especially has been the low fees, where really if all you're doing is just tracking an index, you're not picking any stocks. So there's really not much oversight going on. It's very it's very inexpensive to do that. All you probably need is a good a bunch of tech guys who know how to run some algorithms and have the infrastructure in place to develop a fund that is simply tracking that index. So, passive funds, that's what they're designed to do. There's not a whole lot of other human capital behind, managing an index fund besides that. So that's why one of the reasons why it's gaining popularity is because of the low fees behind it. The other advantage also is transparency. It's pretty much when you're getting into a specific ETF, it's clearly defined what you're getting into in terms of what stocks, how many are there, what is the allocation, and so forth. And on any given day, you can pretty much pull up the index and figure out, what that whole makeup is. So, transparency obviously has been a big thing as of late. And investors like that. They like to know what their money's parked into. The third benefit is also tax efficiency. Because you're basically buying and holding, it doesn't really result in a lot of taxable events, specifically capital gains taxes, whereas with active, that might not be the case. And the last benefit or the last pro for passive investing is there's no manager risk. And what I mean by that is because you're just simply following an index, you're not going to be at risk putting your money with somebody who, for example, made the wrong call in the market. You're basically investing in the market, so there's no risk to that. Some of the negatives behind index, it's really one big one with, and that has to do with, because a lot of index, especially the equity ones, are market weighted. It does leave you unexposed to other new opportunities, right? So what market weighted really means is the larger the company, the more the more allocation it has to that index, so the more allocation is going to be in the ETF. So, meaning to say some of the smaller companies, some of the new emerging companies, or some of the new themes, you might not be in that opportunity, so to speak, right? And that also leads into volatility and risk, where that concentration can actually lead to an index that is top heavy. And the example, and this is probably an extreme example, would be back in the day There was a company called Nortel, and it was a part of the TSX index. And at one point, it made up over 30% of that index. So if you were in an index fund that was tracking the TSX, your exposure to Nortel was 30%, and that was, and it became a very risky index. And the consequence of that was when Nortel did have a fall to grace, the whole index suffered. So, passive investors did feel the brunt of that. And similarly, we're starting to see signs of that even in today's markets. And the last thing that I'll say, which is pretty obvious with passive investing and is negative, is that you will never beat the market because it is the market. So then there's not going to be a whole lot of, in fact, because of the MERs, you're pretty much in the market, you're at the mercy of the market, and so as a result, don't expect any outperformance on that. So those are just kind of the pluses and the minuses of passive investing. Now, just taking a look at what active investing is. Active investing, the goal is quite simple. You're out here to try to outperform the index. And then sometimes that also might mean just minimizing risk, or in a lot of cases, you're trying to do both. Obviously when the markets are going up, you'd like to capitalize on that. And if there's and most of this actually relates to portfolio managers like myself, or even just a regular investor out there that is not doing index investing, right? So in that case, what we're talking about here is somebody who is trying to beat the market and trying to outsmart, and that involves ongoing buying and selling of investments. Now, that we're not necessarily talking about day trading here per se. I mean, that's an extreme example of active investing. Active investing could also mean where you buy and you hold it for a period of time, and at some point you might decide to sell it, and that period of time could be could be months, it could be years. So active kind of comes in different forms as well, right? It's a hands-on approach, and again, like what you're trying to do is capitalize on profitable opportunities and profitable timings, right? And there are different styles as well. I always say that there are different ways to make money in this market. There's an expression, there are different ways to skin a cat, and it's the same thing. There's no one way or style to use when it comes to making the market. There are growth investors out there, there are value investors out there, there are rules-based investors out there. So there's a variety of different methods of doing it, and every active manager is different. Like that's the one thing about active management versus passive, is that when you're looking at passive, it is fairly, the differences between, say, the SPY and, say, an index fund that's tracking the S&P 500, there's not a whole lot of difference there. It's almost minimal. But when we're talking about active investing, active managers, and active funds, the differences can be huge. And ultimately what this really involves, it just involves a whole lot of fundamental quantitative and technical analysis. This is where, portfolio managers like myself kind of roll up their sleeves and see what's going on out there in the market, the sectors, and make a call for our clients, right? So again, going through the pros and cons of active investing right now. So one of the main things, one of the pluses, is that you can manage risk, and you can have the ability to, reduce your exposure to the market, where sometimes things might get overvalued or frothy, and you might have a concentration in one sector. Active investors can have the ability to kind of take the foot off the pedal and reduce that exposure. And subsequently, if the markets are going up, you can have that you can be opportunistic. You can take advantage of short-term inefficiencies. And that's the one thing about active investors is that they don't necessarily believe that the markets are always efficient. And so that's why when they believe that there are inefficiencies in the market, they feel that these are some of the best opportunities where they can make money in the market. And last but not, the other thing about being an opportunistic is that the idea that you can invest in companies that are not reflected in the index. And even in some cases where a particular company is reflected in the index, the exposure might be so small that it's not really going to make a difference. Whereas, again, with being an active manager, you have the ability to take advantage of that. Flexibility to goals. We get this with a lot of clients where there's some specific, requirements. For example, cash flow in retirement. That seems to be a lot of, goals that clients might have, where they have money and they would like to get, cash flow coming in. And sometimes with index investing, you might not be able to, that the yields might not be there. So you have to kind of customize a portfolio in such a way where, you're going out and you're finding maybe stocks and investments that can give you that better yield, right? And diversification as well. I guess it's not just the diversifying your portfolio in different sectors. It's also about diversifying, as a person. For example, if you work in the technology sector, and let's just say you work for Apple, your portfolio might not be best suited. You might want to have a portfolio that is underweight technology, because you're already exposed to technology in your daily life, right? So these are some of the advantages. And as far as taxes go, I put them on both sides, and they kind of cancel each other out. But really, sometimes with active investing, you can do tax strategies that can benefit investors. We have, for example, tax loss and tax harvesting, where, for example, if a client is in a year, let's just say they're in a low tax bracket, then you have the ability to take capital gains. And sometimes if you have a client that is in a high tax bracket, then we will adjust that strategy and make sure that, the tax burden is not as high. So the negatives behind active investing, or the cons, the big one obviously is cost. And that's kind of been, the stuff that you see on the Quest Trade commercials and the ETF commercials, is that active managers do cost more. Of course, time is money. And when you are managing these portfolios, there's an additional cost to that. It's not just an algorithm that's doing it for you, right? So that's the main drawback. Of course, the other thing is performance. Outperformance is not guaranteed. Just because you're trying to beat the market doesn't mean you will. There will be periods of underperformance. And so sometimes, even after paying for that additional cost, you might not get that performance, right? And again, the other thing obviously is taxes. With active investing, because there's been buying and selling that's going on, that might create a capital gains tax, which again can obviously be a drag on return. So what I wanted to do here was this: let's just take a look at the scorecard here and figure out what's happened, in the last decade to start. And so what this chart is telling us, and the table on the left is basically, this is taken from Morningstar. It talks about active large blend funds. These are active mutual funds basically, versus the S&P index funds. So it's a head-to-head kind of 10-year tape. And what you're seeing here obviously is 9 out of the past 10 years, 9 times out of 10, passive has been really dominating active. And what's happened, especially now, what we've seen, like for example in the U.S. Active, there's more money now in passive equity funds than there are in active equity funds, and that's the first time that's happened. I think this happened like last year. So the success of passive investing has obviously been quite dramatic. And a lot of this has to do with the fact that the name of the game in the past decade has been, just lower your cost of managing money, and you'll make more money. And we've seen that. So that's having said that, if one were to just simply look at this chart, they would probably say, that's it. I've made up my mind, and I'm going with passive because, look, numbers can't lie, right? But however, maybe if we rewind on the decade before, you're getting different results. And what you're doing here now, what we've seen the previous 10 years was that 9 times out of 10 active was beating passive. And so, there is a recency bias with passive investing right now, in the sense that, the last 10 years, they've just been on a hot streak, right? But I think what's happening here is this. I mean, a kid can look at the two charts and probably, figure this out, in the sense that when the last 10 years, we've had this phenomenal bull market, and maybe I'll just kind of go to this slide here. it's been an uptrend, and that's all it has been. It's been just a market that's been pretty much going higher. There's been a couple of dips along the way, but overall, the trend has been up, and it's been a pretty smooth trend. Whereas over here, what you have, again, it's a 10-year period. You have a lot of ups and downs. There's really, the market in those 10 years really didn't create a whole lot of traction and really didn't create a whole lot of return. But we've seen that active managers were able to outperform passive, and really it goes back to being at the mercy of the market, where with active managers you do have the ability to maybe make certain moves, especially when markets are going down. So kind of looking at these 2 decades, what does that really tell us? Who wins? I mean, the short answer really is it's a draw, or there's no decision really, because quite frankly, both passive and active investment styles, they're cyclical. They worked in certain periods and they kind of don't work in certain other periods, right? And this chart is just another way of showing what the table previously showed, is that there are there are periods where they just shine in different stages. So I guess now the whole webinar was kind of geared around, well, what strategy is kind of going to win us over, or which strategy should we go forth with? And before we jump into that, right, I think we do have to kind of look ahead here. And obviously it's been a pretty eventful time in the market. And the question really is, what are we looking at here? Are we looking at a V, U, or L-shaped, recovery? And if you don't know what that means, you can just kind of take a look at that chart, and it'll give you a sense of what that means. And a V-shaped recovery simply means that, the economy just hit a small little speed bump in the road, but guess what? It's back, in the second half of the year. That's a V shape. And a U shape is, okay, we've hit a little bit more than just a bump, and it's taking a little bit longer than expected to come back. And, maybe in 2021 or so. And of course, the L shape is much more of a prolonged, it's really bad, and it's going to take, many more years for us to get back to normal. So, I would say this, that even if you are in the V-shaped camp, like even if you're, there are bulls out there, really some bull analysts out there that are much more bullish than I am. Even they would probably say that, even if we do get a V-shaped recovery, like the market has been in the late innings of this bull run. Like as I showed you the previous 10 years where we had that big decade, that uptrend, if you're saying that we're going to get that for the next 10 years, that's a tough bet to make, right? So I think right now what's happened, especially with COVID, we've seen some fundamental economic and social changes that have resulted from this. This is really kind of an inflection point, not just for us as individuals and human beings, but even as investors. And this, however, I do think that this will lead to emergence of new industries and companies. And at the same time, it might actually lead to some demise of some older companies and sectors, right? So that's that's kind of, us trying to look ahead and get a sense of, the pulse of the market. As we see the indexes right now, they are a little bit top heavy, like the top 5 stocks in the S&P 500. They make up about 20% of the index. So again, just to kind of give you an idea, there's 500 stocks in the S&P 500. The top 5 make 20%. So 495 are making 80%, right? So that's the US. If you take a look at Canada, it's not a whole lot different there. You got about 10 stocks that make up close to 40% of the index. So there's a lot of risk concentration there. And we're not even getting into the fact that, those 10 stocks, how many are Sharia compliant or not, right? And once you kind of factor that in, it actually skews the number a whole lot more. So our approach and our recommendation to our clients, we use what's called a core satellite approach. And this is where we're trying to really kind of get the best of both worlds. And so it is a combination of using both. And what we're doing here is we are trying to get the benefits of index and passive investment and make that kind of the core and make that more of a buy and hold. And just to kind of recap some of the benefits of index, you're trying to get that market return. You're trying to get it at a lower cost. Obviously stay away from manager risk. And again, because it's buy and hold, it is more of a long-term focus. So, that kind of is the core. And then what we're also doing with portfolios is that we're complementing that with a more of an active approach, where in the active approach, we are trying to, outperform the market by getting into certain investment themes that we think are geared best towards the outlook. Yes, it does come at a little bit of a higher cost, but we think that, we do have the ability to, not just try to seek a performance, but at the same time, even manage risk. And at the same time, we do get opportunities of short-term, not that we have necessarily a short-term focus, but I would say there's more of a short-term opportunities that do pop up, and we will, from time to time, take advantage of those opportunities so we can create a little bit more of an alpha in the portfolio. So, again, it's going back to that idea that, we are trying to prepare our clients for whatever market outlook lies ahead. Whether it's a V, U, or an L, we're trying to, align our portfolios in such a way where we're really flexible. I'm somewhat of a sports guy, and I think, the best coaches I find are the ones that can make the in-game adjustments. And what we've seen, especially with COVID and the economy and the stock market, is that, the game has somewhat changed. And what might have worked the previous 10 years might, not to say we're going to, totally eliminate that, but it might need a little bit of adjusting to manage for the next decade. And so, I think that's us as portfolio managers. That's what we believe, is that, the best coaches out there just can't, and, just look at history and say, okay, history is going to kind of, dictate the future here. We believe that, a two-tier approach is probably, best suited. So, in conclusion, what we will say is that, despite the recent success of passive investing, we do think that active investing makes a comeback. And we think the current and the future market environment is actually suited for active investing. So we're not of the camp that passive investing is dead. No, absolutely not. There are actually certain asset classes that we actually need for that we need passive investments for. Like, for example, I mentioned Sukuk earlier on. Sukuk is such an investment where we can't actively go out and buy Sukuk, and we, quite frankly, as portfolio managers, we don't think we will really add any value to investing into Sukuks ourselves. So what we would rather do is go into a product that we feel that can give us that exposure, give it to us at a reasonable cost. And, again, it would be an asset class that we think that, we can't add any additional value to. And as I mentioned, it is a two-tier approach. And, the last thing that I'll kind of end off is that, especially when it comes to Sharia compliant portfolios, the core satellite is, I think, one of the best things that you can do for yourself, because it gives you not just the ability to help you reach your financial goals, but it also gives you the ability to make sure that your portfolio, can be Sharia compliant as well. And so you really do have a hands-on approach as far as ensuring that, the investments, are Sharia compliant. So that's pretty much it. So that's my presentation. I guess we'll start the Q&A and.
Absolutely. Well, thank you very much, Brother Nadeem. That was, of course, very eye-opening. You discussed and you explained what passive and active investments are, and for sure, it's part of the mix of what we offer in terms of from an advisory perspective, and viewers out there and attendees, you would quickly realize that that Brother Nadeem does come with tremendous amount of history and experience and the value that he can bring to building your portfolio and managing it through a Sharia portfolio. Like he mentioned, we do offer the access service, which is like the white glove service. It gives you it gives you tremendous amount of support and advisory, and you have a one-on-one with Nadeem on an ongoing basis. So, I think, you definitely got to make contact with Nadeem to ensure you can A, take advantage of his experience, and B, have him guide you through Sharia portfolios, and how it can be of value to you. Of course, we are quite unique in the sense that we do offer much of what TD and RBC and everyone offer at the same service level, at the same professional level. But we are a dedicated Sharia company that will provide you as a Muslim the value that you honor and cherish every day in your life. There,
yeah, I'll answer some of the questions that we have coming up
sure.
here. I'll start with this: investing in a Sharia compliant ETF versus Islamic mutual fund. What are the differences in management fees? So, I mean, off the bat, the Sharia, the ETF that we use, which is called which is actually the SP funds, Sharia S&P 500 industry exclusion ETF. The symbol is SPUS. The MER on that is 0.49%. Whereas I think the Islamic mutual fund that I think the one that's available in Canada, I believe the MER is something in the ballpark of 2% or so. So that's kind of, just to kind of give you an idea as far as what's the difference. Now, in our Access portfolio, we do have an account fee that we do add on to it. And that account fee can vary, but even after you count the account fee, it's nowhere near 2.8%. It's still 50% lower than the 2.8% at the mutual fund. So typically with mutual funds, yes, it's north of 2%. I think 2.8 is the number that I recall. For our ETFs, it's 0.49%, and with a management fee. So another question that I have here is a W-shaped recovery a possibility? Yeah, absolutely. I think a W-shaped recovery would kind of look something like an L, but a little bit more trending. So in fact, with a W-shaped recovery, yeah, we've probably seen it in the past. It's a combination of probably a U and an L. And I know we're just kind of playing with letters here. But there's a possibility that we could get that. And if we do get that, that would again make more of an argument to have active management in your portfolio. There's another one here. At Sharia portfolio, what are the top 3 sectors that are most heavily invested within your fund? So 2 things here. We have an ETF. And then we have the Access portfolio. So with the Access portfolio, basically our top sectors are technology, healthcare, and I guess if we're just looking at equity and not fixed income, I guess you could say gold would be the third third highest exposure that we have, and kind of in that order. If you were to take out gold, I would probably say consumer discretionary, but technology, healthcare, and gold would be probably the most top sectors in the Access. Now, in the ETF, it would be technology, healthcare, and I believe consumer discretionary. I might have to get back to you on that one, but definitely technology and healthcare would be the 2 ones. There's another question here. On a 50-year historical basis, longer term, how often have actively invested funds outperformed passively invested funds? Now, I don't have a 50-year number, but I do have a 35-year number. And the 35-year number is basically out of 35 years, 15 years actively managed has beaten passive. And of course, the 20 would be the other way around. Passive has beaten active. And one second. Do you plan to launch future ETFs focused on sectors versus broader markets? like the index-based ETFs. There's a how is the current ETF subscription? Do you have a lot of institutional investors abroad? Well, I mean, these are many questions here. I mean, we're just kind of, we're obviously we launched these two ETFs, the SPUS and the SPSK, which is the Sukuk index. We launched that in December of 2019, and alhamdulillah, we've gotten a lot of interest from them. There's been growth in the funds. And I think, our firm believes, you have to, let's walk before we run. And I think we're taking a prudent approach to growing the firm, as, Canada in itself is an expansion. And, inshallah, as the firm grows, I would imagine that we would have more product offerings, going forward. Here, okay. What are the typical rate of returns one should aim at with the combined approach? Okay, so a couple of things. I mean, we, even in the Axis portfolio and even with the core satellite strategy, we still have 4 different models. So in other words, anywhere from somebody who's very conservative to somebody who is an all aggressive, all stock portfolio. So the returns do kind of vary. And then I guess you could say, for somebody who's conservative, again, we don't have the track record in Canada. We just kind of launched our portfolios, at the start of 2020. But if we were to kind of look at our US models, just to kind of get an idea as far as what the expected return should be, we can do that. However, the rate of returns are going to vary. The approach is the approach. The approach is more about how do we actually manage the money. And what kind of really dictates the return is what your profile is. Are you somebody who's very conservative, or are you somebody who's very aggressive? Typically, just to kind of give you an idea, our aggressive and our growth models are kind of around the double-digit area, where you're getting, maybe like a 10 to low teens type of return. And of course, if you go to conservative, you're looking at something like a 5.5 type of annual rate of return on that. And so, 1 second here. Are the fees a percentage of returns or a percentage of the value of the account? So basically, it's the value of the account. So for our Access offering, what we're basically doing is, it's the value of the account. So hypothetically, let's just say if you had 100,000, and it would be based on that, it would be a percentage. It's an annual rate that, and the account is basically charged on a monthly basis. So that is prorated. So for example, to give you an extreme example, just for the sake of math, if in January you had 100, the portfolio was at 100, but come December, the portfolio is at 150, then what? You're going to be charged the 150 for the month of December. The value that's being charged is going to be based on 150, not 100. I hope that makes sense there. Okay, there's somebody that started off with stupid question, but I don't think there's no such thing as a stupid question. So you guys manage both passive and active investments, or does passive investments imply that investors themselves either select stocks and or select existing index and self invest? Okay, so a couple of things here. When we say passive investing, it's not do-it-yourself. Do-it-yourself investing is different. You can be a do-it-yourself investor. In other words, go pick your investment yourself. You could do it passively, or you could do it actively. So in other words, you can go online and decide, hey, you know what, I'm just going to buy index funds, and guess what, you're a passive investor. Or you can decide, you know what, I'm going to create a stock portfolio, and that makes you an active investor. So that's the definition of what we mean by passive versus active strategy, right? So what we're doing is passive and active are kind of tools. So we do use some passive in the form of using indexes, using ETFs, as our passive tools. And then subsequently, we also use an active approach. And for active approaches, what we're doing is we're using individual stocks. So that's kind of the difference between the two. Okay. I have a question here. It says, thank you for launching a Sukuk ETF. The community really needed such a product. Does the Sukuk ETF pay quarterly or monthly dividends for an income investor? Concerns with the current Sukuk constituents. Unfortunately, due to COVID, real estate might get hurt in the Sukuk ETF. Does the manager plan to reallocate out of commercial real estate properties in the GCC or lower exposure from commercial real estate? Well, it's a loaded question there, but I'll start with this. First of all, thank you. Thank you for the thanks. You're most welcome, and inshallah, we hope to do more for the community and launch more products. The Sukuk ETF actually pays monthly. So every month there is a cash distribution, that the ETF pays for our income investors. As far as the concerns of the Sukuk fund itself goes, so and for some of those who don't know what a Sukuk is, and I'm going to try to simplify this as much as possible. It's a Islamic bond that there is an underlying tangible asset. So these are issued, a lot of them are issued by governments, but these are basically bonds that have a tangible asset that's tied to them, and that asset is generating revenue. So this brother or sister who posed the question about real estate and the exposure in GCC, well, the good news is that surprisingly, our Sukuk doesn't have a very strong weighting in the real estate sector. So, it might come as a surprise to a lot of people, and in some cases, it actually even came as a surprise to me. So that's number one, is that the exposure in real estate is actually not what you would think it is. It's not. This is not a mortgage backed security. So I think, and it's actually a pretty well diversified Sukuk fund. So first of all, the Sukuk fund is tracking the Dow Jones Sukuk Return Index, and it has about 75 to 80 Sukuk, individual Sukuks in there. Now, most of these Sukuks, they're issued by sovereign governments, some corporations, and they're diversified. So it's not just the GCC. There's Saudi Arabia, there's Indonesia, there's Malaysia. And so it's not, the risk is somewhat diversified out there. And, again, because we're passive investors, we're not actively making a call on the Sukuk. But what I will say is that the outlook for the Sukuk market actually looks quite positive going forward. We think that, as you hear the world kind of say, look, zero interest rates. Well, the Sukuk fund actually offers a pretty, interesting yield in a low rate environment that we're seeing right now. Do you invest in markets outside of North America? If not, would this be considered as an option going forward? So we invest into stocks that trade on North American exchanges. And in some cases, what might happen is we do get companies that are listed, for example, in a North American exchange, but are actually, not North American companies. So, in a lot of cases, we see Asian ADRs that they're called American Depository Receipts. So as an example, just to kind of throw in an example, not that we buy this or we own this in our portfolio, but just to, throw out a name that people might be familiar with, Alibaba. It's obviously a Chinese company, and, the bulk of its business is in China, but its shares actually do trade on the New York Stock Exchange. And in the past, we have owned companies outside of North America. We've owned European companies in the past. As of right now, off the top of my head, I think in some of our US models, we might own a couple of European pharmaceutical companies. But yeah, so as long as it's listed on the North American exchange, we're open to looking at them into our portfolios. And in some cases, if we are, for example, bullish on a particular country, we might actually actively look at those specific ADRs that are out there. What is the rate of return on the Sukuk investment? Okay, so a couple of things here. So the rate of return, again, we launched this in December of 2019. So, you know, we basically have a 6-month kind of track record that you can kind of look up. However, you know, if you look at the index, because the fund, the Sukuk ETF that we have tracks the Dow Jones Sukuk Return Index. If we were to pull up that Dow Jones Sukuk Index, the 10-year average return is just under 5%. I believe it's at 4 point. This might be as of December 2019. So it's about 4.8, 4.9% as a total return. So what that means is that that's a combination of yield plus any capital appreciation, you know, in that index. So that's been the return on the index that the ETF tracks. Again, going back history. Right now, the yield right now on the Sukuk is about 1.75%. That is the the current yield on the ETF. So in other words, that would be, you know, what you could expect. Now, at the same time, you know, it's not like a GIC where, you know, there might be some potential for capital appreciation or depreciation, because it is something that does move up and down, but slightly. You know, historically, the volatility on the Sukuk index and the Sukuk ETF has been very minimal. If I were to invest 50,000 US, what's my return on investment and fee for the conservative investment? So I would say that, you know, for something like that, I would probably schedule a call or reach out to me directly, and we can walk through that. You know, again, I think I answered the previous question as far as conservative. What have our conservative portfolios done in the past? Again, I can only give you an idea, an expected return as far as what's been the past 5-10-year number. And that number has been around 5.5%. That's been the expected return on investment for our conservative. As far as fee goes, again, that's something that we can discuss, because it can depend on, you know, which type of portfolio is best suited for you. It could be Express, it could be Axis, and so forth. And do you have any plans to offer any insurance products? You know what? Not as of yet. I mean, of course, if we can offer a halal insurance product, you know, we would, you know, consider that. I mean, a lot of, you know, as a business, you know, we love to offer every halal financial product out there, but, you know, at the same time, you know, it is a business, and it does come down to, you know, a cost and analysis. You know, is this something that we can offer to the community, but at the same time, you know, make it viable for us as a business, right? So I think, you know, our goal, inshallah, is that as the firm grows, and maybe I might just kind of end the webinar with this, is that, you know, we're a believer in Islamic finance, obviously. We think that as our firm grows, we can not only, you know, we can, first of all, we can even, you know, hopefully reduce some of our fees. Like if you even that's just a normal function. Like as you get volume, you're able to scale your business, right? So that's number one. And number two, I think, you know what, as our firm grows, we're hoping that we are able to offer more products, whether it's more ETFs, more, you know, other types of, you know, like insurance product and so forth, right? I think we just got to Canada. We're obviously very excited, but at the same time, we want to make sure we grow at a steady and safe pace, inshallah. So,
well, great. Well, thank you, Brother Nadeem, for the presentation, and of course, doing a great job with the answers to those questions. And I'm glad that so many of you were able to get your questions in on time so that Nadeem can address them. With that, I just want to say thank you again. Really appreciate the time you took from your busy Wednesday evening and to spend it with us and to learn a little bit more about Sharia portfolio and who we are, what we offer, and the value that we bring to your goals, your financial goals. With that, I want to say thank you again, every one of you. Thank you, our presenter, Nadeem. And please visit our website, visit our social media sites, and where you can learn more about us and you can learn more about future and upcoming webinars and events that we may be having in your community. Please, stay safe, you and your family and your community. And we look forward to having you join our family of Sharia portfolio investors. Thank you again and do have a great night. Jazakumullah khairan. Assalamu alaikum wa rahmatullah. You there?
Yeah.
Oh, gotcha. So are we done? Let me see this here. Hold on a second.